We are in a huge debt-cum-credit bubble. Now, when that starts imploding, what you're going to get is you are going to get a weakening dollar. The dollar is going to go down, its purchasing power is going to go down, and if you like, the first signal we've got of that is the gold price measured in dollars rising. If you do have gold, and particularly if you've got legal tender, it varies, the laws vary from country to country, but if you've got legal tender, then you can presumably use your gold to buy real estate, for example, or buy farmland, or nice country estates, or a hideaway away from anywhere, which might insulate you from trouble.
The global financial system is walking on a knife edge. Decades of artificially suppressed interest rates and relentless credit expansion have inflated one of the most enormous debt bubbles in history. As that bubble begins to implode, the warning signs are already visible: falling purchasing power of the dollar, surging gold prices, and widening distortions between bond yields and equity markets. These are not random events, but signals of a deeper structural failure in the fiat system. When currencies are backed solely by credit and confidence, collapse comes swiftly once that confidence evaporates. What follows is not just economic instability, but social and political turmoil, as history has repeatedly shown. Alasdair Macleod, a seasoned economist and head of research at Gold Money, has spent years analyzing the flaws within the modern monetary framework. With a background in banking, fund management, and economics, his work focuses on economic history and the dangers of unchecked credit expansion. His warnings often highlight the parallels between today's fragile financial order and the catastrophic collapses of past fiat systems. Macleod argues that in the face of an unraveling credit bubble, tangible assets like gold and silver remain the only reliable forms of wealth preservation. History does not repeat, but it rhymes, and today's inflationary crisis is echoing past monetary breakdowns. Protecting wealth is no longer just about investment returns. It's about survival in a failing system. Now, we present the clips from Alistair Macleod's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates, and enjoy the video.
We are in a huge debt-cum-credit bubble. Now, when that starts imploding, what you're going to get is you are going to get a weakening dollar. The dollar is going to go down, its purchasing power is going to go down, and if you like, the first signal we've got of that is the gold price measured in dollars rising. So we're talking about the relationship between real money without counterparty risk and credit. Secondly, we've got the long bond yield, which will break out above that 5.1% level, I think fairly shortly, could be within weeks. And thirdly, we've got the extreme valuation disparity between the yield on the long bond and what's going on in equities, with the S&P hitting new highs. I mean, since that first peak, about 5.1% in the long bond, I mean, you would think, well, no, go back a little bit. When it broke out of a long-term downtrend of yields, I'm going back to, 2022, around about early 2022, when it soared through 3%. We had, at that time, I think the S&P was around about 4,200, something like that. Now it's 6,500, despite the long bond yield continuing to rise. In other words, this is a bubble. Who cares about valuations? We're going to buy because it's rising. And you got the speculation in Bitcoin and all the rest of it. I mean, this is a speculator's market. It is a credit bubble. When that bursts, it's going to have a profound effect on the dollar. Well, if you don't hold gold, and I suppose also silver, I mean, there are other things, in this sort of catastrophe, actually having the means of producing your own food actually does become rather important. Living in cities puts you at a great disadvantage because the distribution of the basics which we need, I mean, particularly food, that's going to break down. I mean, who with sort of producing, whether it's vegetables or meat or whatever, is going to want to sell stuff into cities for people who can't afford to buy it? Well, sorry, cattle, you're going to live a bit longer, sort of thing. I mean, that is a real trouble. If you have credit, you'll get wiped out. It's as simple as that. I mean, think what 4 trillion marks were, if you like. I mean, it was some figure like, I can't remember, but I think before the war, the total money in circulation was measured in sort of, I think it was measured in billions of marks, of Reichsmarks, not trillions. even possibly millions. But I mean, it was a very, very low figure. So if you've got unbacked fiat dollars, they're not going to buy you a cup of tea at the end of the day. On the other hand, if you've got gold, you can cash that in for worthless dollars, which you'll spend extremely quickly before they become even more worthless. I mean, that was the lesson, really, of that experience. And not only that, but if you do have gold, and particularly if you've got legal tender, then you can presumably use your gold to buy real estate, for example, or buy farmland, or nice country estates, or a hideaway away from anywhere, which might insulate you from trouble. But I mean, this is a very, very serious issue. It's going to be very damaging for actually everybody, because let's face it, very few people actually have gold or have gold in any sort of meaningful way. And I mean, we haven't even touched on problems that follow. I mean, if we pursue the analogy with Germany, of course, the complete collapse of the currency and the economy in 1923 led to political instability. It led actually to Nazism, Hitler, and all the rest of it, and World War II. So the idea that this is just going to get the whole thing out of get it out of the system, and then we can get on with lives. And it's not that simple. It really is not. So you're going to continue to be very wary about the situation following what is now looking like going to be a great inflation yet again, a collapse of the currencies, fiat currencies. And the thing that is actually very worrying is I can't see how any politician in the West has the mandate to actually address the problem. And it's in that context we should be more sympathetic about the problems that the German political class felt or faced back in the early 1920s. I'm sure, and if you read into it, you will find that there were people who knew what they were doing, but they basically had no alternative. That was the way of it. Get out of credit. I know it's not easy, and you can't get out of credit totally, because gold never actually circulates as money, and it hasn't really done since medieval times. It's credit which circulates, and people just don't understand this. So you have got to have some exposure to credit, but just make sure that you've protected yourself against the events which we've been discussing in this video. They are going to happen. And I think they're going to happen really in the not too distant future. Things move a lot more quickly today than they did in the 1920s. I mean, in the 1920s, you bought things with cash and then barrelloads of cash when cash lost its purchasing power. People wouldn't take checks from your bank account because it took 3 days to clear. And in 3 days, what happens to the value of that check? I mean, it just goes down with everything else. And nowadays, of course, payments are instant. It's electronic. So you don't quite have the same problems that we had at that time. Technology is advanced, obviously, from a banking point of view. Then you've got to consider whether your bank is safe. I mean, we know that the Fed's turned around and the Treasury's turned around and said, we will absolutely make certain that the banking system retains its integrity. We will not let banks fail. A failing bank will always be bought out and depositors will be protected. And they have to do that because the FDIC protection isn't enough, actually. It's a small part of the total liability. So, I mean, there are all sorts of things to think about. The main point, I think, is to understand what is going on and to have some gold. And that's why I've set up my Substack, to basically educate people who are not necessarily in the finance sector to really understand what's going on, because you go to the finance sector and try and get advice on the future, and you will always get the same thing from people who themselves are totally ignorant of what's going on, what is happening to currency. I mean, they think currency is money, which it isn't. It's credit. It's just another form of credit. It's the highest form of credit.
At the peak of every great bubble, the same dangerous psychology emerges. Borrow to buy, because prices will only go higher. That mindset is alive today, just as it was in past manias, where valuation no longer mattered and speculation was fueled by easy credit. This same behavior preceded the devastating collapse of the German Reichsmark a century ago. After the First World War, the currency saw sharp inflation, followed by a brief boom that convinced many the worst was over. Stocks surged, the mark temporarily strengthened, and ordinary investors piled in, believing prosperity had returned. Yet beneath the surface, the credit structure was rotting. By late 1921, markets peaked, the currency began its terminal decline, and hyperinflation took hold. The parallels to today are striking. Inflated equity valuations, rising bond yields signaling a buyer's strike, and governments forced into endless credit creation. Once confidence breaks, the system must choose between a market collapse or a currency collapse, and history suggests authorities always sacrifice the currency. That path leads directly to the final stage of monetary breakdown, where only tangible assets, such as gold, retain their value. Let's get back to the interview.
I mean, they will be saying to you, look, it's a dead cert. The market's always going up. We can't stay out of it. So we're going to borrow in order to buy more stock. I mean, we're going to make lots and lots of money. Isn't it wonderful? Yeah, of course that's going on. But that again is, we see this sort of thing at the top of every bubble. People who really don't know what they're doing, getting involved in stocks. Why? Because they're going up and they will always go up. As I say, the valuation disparity is now at record levels. It is fright. It really is fright. So that's sort of where we are. Now, you asked about the comparison with Germany between 1920 and 23. Well, between the end of the First World War, which was November 1918, and 1920, there was a significant fall in the purchasing power of the Reichsmark. Call it inflation, if you like, which I think is actually a sort of bad description. But anyway, there's a big fall in the purchasing power of the Reichsmark. But then, and this sort of fits in, if you like, with the war on our economies by shutting down everything during COVID. That was the equivalent of 1918, if you like, as far as Germany was concerned. The economy was completely shattered and we had to recover. And there was an inflationary outcome. We saw this with inflation running up and peaking in, I think it was 2022. In that case, it peaked in 1920, 102 years before. Interestingly, from that point, there was a boom. And not only that, but the mark was the best performing currency in the world. I mean, it was an extraordinary situation, financial boom. And the stock market rose 300% between the beginning of, I think, around about February 2020 and December 1921. Everybody was doing exactly what we're doing now, what you described, mom and pop, getting into the market, buying it, becoming wealthy. But meanwhile, of course, the laboring classes who didn't have access, if you like, to the stock market to improve their position, they weren't doing nearly so well. They really weren't. There was employment, but not enough really to spread, if you like, the benefits of a booming economy from sort of, if you like, from the very wealthy all the way down the pile. But then what happened was that on December the 1st, 2022, 2021, the stock market peaked. And then, I think in that December, it fell something like 25%. And that marked the beginning of a next phase of what was happening. And that was a new downward acceleration in the purchasing power of the Reichsmark. And it was from that point that it started falling. It was from that point that, if you like, government printing of the Reichsmark accelerated because things weren't going well. You had the credit implosion happening. So what did they do? They increased the amount of government credit to counteract the contraction of private sector credit. And the result was a collapse in prices. The collapse in prices continued right up to November 1923. And by 1923, one Reichsmark, which before the First World War was worth 23 US cents, was finally fixed, if you like, at roughly 4 trillion to the dollar, from 23 cents to 4 trillion to the dollar in November 2023. Complete collapse of the currency. Everybody was wiped out. I mean, except the really wealthy speculators. The Hugo Stinnes, who was known as the inflation king. There's a guy, one of the Thiessens was again a similar situation. Fritz Thiessen it was. You had a few of these guys who really knew how to play the inflation game. And basically the inflation game then was very simple, and it's not available to us today, by the way. And that was for Germany to export to America. Those exports earned gold-backed dollars, which compared with the declining currency, the collapsing currency, was obviously a tremendous benefit for the industrialist. And not only that, but his manufacturing costs were declining because of the collapse in the Reichsmark. And indeed, the industrialists like Stinnes and Thiessen were very much against any attempt to try and stop the hyperinflation. I mean, they were winning from it big time. And, if you were in that position where you were earning dollars, you could buy almost anything. The situation where, $100 could buy a 6-bedroom house in the swanky part of Berlin, which literally 2 years before had been really incredibly wealthy. I mean, when you think about the effects of the boom, it's rather like booming stock market. So what does that do to Manhattan apartment prices? Oh, exactly. So you can see, the collapse then in terms of dollars, measured in dollars, was almost total. I mean, as I say, $100, you could get something fantastic. Mind you, $100 was a hell of a lot of trillions of worthless Reichsmarks. So, but the lesson there is quite simple. And that is that under these circumstances, you get out of credit and get into real money, which obviously is only gold without physical gold, without counterparty risk. But the lesson in all this is something which I don't think I've seen written before. And that is that we are actually, I know things rhyme rather than actually sort of replicating, but we are seeing something very, very similar to what happened in Germany currently between 1920 and 1922, that's the current phase. It was preceded by something very, very similar from 1918 to 1920 in terms of purchasing power of the currency. Will we embark on that last phase? Well, I think the answer is that if I'm right about bond yields rising at the long end, long bond yields rising, effectively a buyer's strike, people no longer wanting to buy government debt because of the whole thing's going wrong. That is going to break the stock market. It'll mean that banks start foreclosing on loans. And particularly, you mentioned, people who've gone out and borrowed on margin and all the rest of it. To cover those margin payments, they will be sold out into an unwilling market. And what does the Fed then do? Well, the answer is that the Fed has set itself up, and the Treasury, if you like, has set itself up to be the buyer of last resort for everything. So what's it going to do? Well, the answer is going to try and stop a complete collapse in the economy, which means that it'll basically crash the currency. So that's what you're going to get. I can see how it's going to play that third phase that we saw in Germany between 1922 and 23. I can see that's ahead of us. And of course, what happens to the dollar also dictates what happens to the rest of us. Whether we've got a debt trap or whatever, it actually becomes a bit irrelevant. We have, and it will make things worse, but the timing of this is actually in the dollar.
Throughout history, every great bubble has carried with it the same illusion, that this time is different, that rising markets will never turn, and that credit can expand forever without consequence. Today, we see soaring equity valuations, speculation in unbacked assets, and a financial system leveraged to extremes, all while government debt climbs relentlessly. When debt and credit structures begin to unravel, currencies are inevitably sacrificed to preserve the system. In moments like these, tangible stores of value matter most. Gold, silver, productive land, and essential resources have always served as lifeboats when paper promises collapsed. Unlike credit, they carry no counterparty risk. Protecting wealth means preparing ahead of the storm, not reacting after confidence breaks. The lesson from past crises is clear. Those who relied solely on credit or fiat money were wiped out, while those who held tangible assets endured and often emerged stronger. The urgency now lies in recognizing that events unfold much faster in the modern world. Electronic payments and instant credit flows accelerate both the boom and the bust. Waiting for the signs to become obvious may leave little time to act. That is why prudence demands foresight, diversification, and a measured allocation into assets that cannot be printed into worthlessness. If you found this analysis valuable, don't forget to like the video, subscribe to the channel, and share your thoughts in the comments below.